Hey guys, welcome back to IPDA X Foundations. And today we're going to be going over top-down analysis and directional bias. So let's get right into the video. All right, so before we, take a look at concepts and all that stuff, I need to address a few things to make sure that you guys are, approaching this whole idea of top-down analysis and directional bias in the proper way. So that's why I have this slide here first. And as I read through this, I'll highlight a few key things, and then I'll try to elaborate on them after I'm done reading. But basically, stop focusing on being right. When wanting to learn about directional bias and top-down analysis, what people are really wanting to know, if they're being honest with themselves, is how to not be wrong in the markets or how to be right every single time. And this is not the proper mindset to approach trading with. All right, so let me highlight that first. All right, and then you can never be right 100% of the time. Only the market is right 100% of the time. And this top-down analysis slash daily bias approach is just a logical system that we use to determine what the next most logical direction in price is going to be. All right, so let me highlight a second thing real quick. All right, so going to this blue highlighted portion right here, or this blue underlined portion, it says, this is not the proper mindset to approach trading with. Now, what I'm trying to say here is that as humans, we're not properly equipped to be traders, right? So we have all that stuff with fear and greed and all that stuff going on. So that's why we're not, properly equipped to be traders. We're not equipped to, be successful in trading, because to be successful in trading, we need to go against so much of our instincts, so much of our natural instincts that we have, in order for us to, really be successful with our trading. And then this next part that I have is you can never be right 100% of the time. Now, the reason that I have this highlighted is because, this may seem self-evident. Most people lie to themselves and think that, they know this, but they really don't. Because if you really believed that you can never be right 100% of the time, then you wouldn't be system hopping. And the fact that you're here at IPDA X, kind of shows that you still believe that you can be right 100% of the time. Now, let me draw an arrow over here and then try to explain that a little bit more. All right, so you guys probably found ICT, or maybe you guys started with retail, right? So you guys started probably with retail trading, and then from retail trading, you guys tried the whole support and resistance and trend lines and all that stuff, and then that didn't work for you guys. So from there, you guys probably discovered smart money concepts or whatever. You guys did supply and demand and all that stuff or whatever. And then from there, you guys found ICT, you know? So during this entire process, you were trying to be right 100% of the time, right? So you came to retail learning about support and resistance, and then chances are you took more losses than wins, and then you thought that that was not, successful trading. And that kind of builds into this point right here. So most people think that you have to, be right like 70, 80, 90, 100% of the time in order to make money. But that's not the case. Trading is very probability based, right? So that means that you can be wrong and still make money, right? So that's why this portion that I have underlined in blue is so important, because that's something that most people don't come into trading with. They don't come into trading with that mindset, thinking that, that they can be wrong and still make money. They think that you have to be right, like 80, 90% of the time. And, it's very hard to find something that, succeeds that much, because there's always a bit of error in whatever strategy that you trade. So it's not necessarily about, it's not necessarily about the system, but it's rather your decision making is what's going to make you profitable in trading. And building on that, if you guys have seen that video from ICT called The Keys to Daily Bias in Forex, in that video, ICT doesn't necessarily talk a whole lot about the charts and, which concepts he uses to, find out, how he knows where the market is going to go. Instead, what he focuses on in that video is he focuses on psychology and decision making and stuff like that. And he says something very important in that video. He says that even if you knew where the market was going to go, you would still find ways to make mistakes. You would still make mistakes even if you knew where the market was going to go. And what he means by that is it's not about knowing where the market is going to go. That's not the holy grail of trading. The holy grail of trading is mastering your decision making and ultimately, mastering that moment of when you press the button. That's what makes you profitable. That's what makes or breaks you as a trader. And that's why I have this blue part highlighted. That's why it's so important. That is the proper way to approach trading. All right. And then building on that idea of you can never be right 100% of the times, so let's go back to this. So you failed with support and resistance, or quote unquote failed with support and resistance, and then you went over to SMC thinking that, oh, this stuff looks cool, let me try this. And then, chances are you probably blew accounts or didn't, see the level of success that you wanted to with that. And then now you jump to ICT. And then the whole time you didn't accept the fact that you were going to be wrong. So maybe you took a string of losses, maybe you took a L, you took all these L's, and then, you started to, get emotional, and then you started system hopping. Now that means that you think that you have to be right 100% of the time. You don't, right? So your actions aren't necessarily lining up with, you claiming to know this, right? So the fact that you're system hopping all the way over to IPDA X means that you don't truly believe this. You know that, this is true, but you don't believe it. And at IPDA X, we say that this is your last stop in your trading journey. And if this truly is going to be your last stop in your trading journey, we need to address this root cause of, what's causing you to fail and what's causing you to system hop. And that root cause is what I just explained right here. You're not properly approaching the markets, and you still think that, that you can be right, 100% of the time. And, out of those two things, that's where FOMO, greed, fear, all that stuff stems from. Those things are just systems, or not systems, but symptoms of you not, properly approaching trading. And, that's not necessarily, anybody's fault. It's just, the programming that we come into the markets with. But that's just something that I kind of, wanted to let you guys know about before we start, going into, the actual concepts and the how-to of the top-down, approach and, the daily bias stuff. Because most people think that if you can somehow teach them how to know where the market is going to go, that's all they need. But that's not it. There's so much more, to trading than just knowing where the market is going to go. Because I've had days where I knew where the market was going to go, or I like had a very, very good idea of where the market was going to go, but I didn't end up making money that day or that week. And I've had times where I didn't necessarily know where the market was going to go, but I still ended up making money. So it's not about knowing, where the market is going to go. It's about your decision making, your, thinking in terms of probabilities and risk management. Those things are the holy grails of trading. That is what you guys are ultimately looking for. It's not the concept, SMC, ICT, retail, all that stuff. Because at any of these schools of thought, at any of these methodology, there's successful traders and there's unsuccessful traders. And it all boils down to your decision making and all that stuff that I mentioned about discipline and risk management and all that stuff. All right, so quick little rant about that, but very necessary because most people don't approach this in the right way. But now let's move on and go on with the actual concepts and how to do a top-down analysis. All right, so just as a quick preface before we go into the concepts. So these concepts aren't necessarily a step-by-step. They're more so things that you need to keep in mind. So I'll show you guys more so what a step-by-step, process looks like when I actually go into the charts and then we analyze a currency pair. But just know that in this slideshow, I'm just going over a few key things that you guys need to keep in mind at all times when you're doing your, when you're looking at the charts. All right. And the first thing that we keep in mind is our mental frameworks. So when we cycle through all of the time frames, it is important to keep our two main mental frameworks of stops to inefficiencies and order flow in mind. And these concepts are fractal, and we use them on all time frames. So, just from the quarterly chart to the monthly, to the 4 hour, to the daily, all the way down to the 1 minute, we're always looking at stops to inefficiencies and order flow. So this is fractal, and we always consider these two things because those two things are probably, the two most instrumental pieces of our entire trading and our curriculum. All right, so let's move on to the next slide. All right, so here's something that you guys don't necessarily or probably haven't necessarily considered, but it's very, very important when, understanding bias and top-down, the top-down process, and that is interest rates. So before looking at the charts, we need to understand some macroeconomic factors that influence the markets. The most important macroeconomic factor that we consider is interest rates. All right, so the currency with the higher interest rate will go up against the currency with the lower interest rate. And interest rates help us understand where the market is predisposed to go to. And then I have one more thing here in the parentheses that says that interest rate effects usually take a while to be seen in price. So I will go into this after explaining this other part right here. So the first part that we need to take a look at is that the currency with the higher interest rate will go up against the currency with a lower interest rate. So let's say that currency X has an interest rate of 5%, and currency Y has an interest rate of 2%. So that means that let's say that we have this currency pair called XY. So remember, we consider the currency that's in front, right? So right here, we see that X has a higher interest rate. And this currency pair XY is mainly concerned with this currency X. So that means that the currency with the higher interest rate is going to go up, and X has that higher interest rate. That means that this currency pair XY is predisposed to go higher. All right. And then let's take a look at a different one. So let's say that we have currency pair A, and then we have a currency B. All right, so let's say that A has a interest rate of also 5%, and then let's say that B also has an interest rate of 2%. All right, and then let's say that we have a currency pair called BA. All right, so as I mentioned, when we have a currency pair, we're mainly concerned with the currency pair or the currency that's in front. And here we see that A has a higher interest rate than B. So that means that B is going to go down against A. And then remember, when we have currency pair BA, we're concerned with B. And that means that if we're concerned with B and B has a lower interest rate, that means that this market is predisposed to go lower. All right, so we'll take a look at what this looks like with actual currency pairs, but I'm just using this to, give you guys a framework to better understand this. So let me clear this out, and then let's go over this part right here. So what I mean when I say that interest rate effects usually take a while to be seen is, so last year, just for example's sake, the Federal Reserve, which is the central bank of the United States, they started raising the interest rate, right? And then during that time, the euro, so EU or Euro USD, was going lower. And then they started to raise the interest rate on the dollar, right? So the dollar interest rate was going up. And right now, the dollar has a higher interest rate than the euro. But during this, price was going up, right? And then as I said, the currency with the higher interest rate should be going up against the other one. And then this is EU. So EU should be going down, but it's actually going up. Now, why was that? Well, we know that this market was predisposed to go lower based on the interest rates, but you can't just take it lower just like that. You need to engineer liquidity, right? So going lower means that, price is going to, go down. But in order to go down, or, in in order for price to sell off, you need to sell to somebody, right? And in order to sell to somebody, people have to be buying. So all of this price movement going up was to get people to buy the euro. And then once, we reached our levels that we needed to on the euro, and once, we had enough buyers, for smart money to pair their orders with, that's when, we're starting to see price go lower on the euro. And that's what I mean when I say that interest rate effects usually take a while to be seen in price. All right. And then if you guys want to, find a website for interest rates, you can go to this one right here. So that's like where I get my interest rate information from. And then we'll take a look at this website later on in this lecture as well. But yeah, that's pretty much everything for interest rates. So let's move on to the next slide. All right, so the quarterly chart and higher time frame institutional order flow. All right, so the market delivers on a quarterly basis, and that is why we should start our higher time frame analysis from the quarterly chart. And from the higher time frames, we need to see what the order flow is. So let's say that we're in a bullish market. All right, and then we have, something like this, just for example's sake, right? So let's say that we have equal highs on the quarterly chart or the 3-month chart, right? So 3-month or quarterly chart is the same thing. And then now, we're starting to go up, and, order flow is bullish and the quarterly chart is bullish. All right. So that means that this is going to be our draw on liquidity from that 3-month, perspective. So markets deliver in quarterly cycles or on a quarterly basis. So we need to start our higher time frame stuff from the quarterly chart. And here we can see that, price is bullish and we have a target set in price over here. So now we know that a higher time frame institutional order flow is bullish, and also we have our target set up here. So now we can be looking for, bullish prices up until this point over here. So that's how we would use that quarterly chart. Now, there's also something called quarterly shifts as well, but we'll take a look at that, in future videos. So don't concern yourself with quarterly shifts too much at this point, but just know that, that quarterly shifts do happen, but we'll cover that stuff in subsequent lectures. So that's how we use the quarterly chart and the higher time frame institutional order flow, starting from the quarterly chart. All right, so let's move on to the next part. All right, so PD arrays. Price is always coming from and going towards higher time frame PD arrays. Therefore, when doing top-down analysis, we are mainly concerned with which higher time frame levels that price is reaching for. And that is going to be called our higher time frame draw on liquidity. So going back to that drawing that I had with the quarterly chart, we can see that the higher time frames are bullish and we have a level above us in price that we're trying to reach. So this level right here, let's make that a different color. This level right here becomes our higher time frame draw on liquidity. All right, and that's the level that we're going to be bullish until. All right, and then the benefit of having higher time frame draws on liquidity is that it takes a while for price to actually reach that level. So you have a lot of time to actually, to be trading and have a directional bias in price. So one thing that I do want to kind of elaborate on is that price is always coming from and going towards higher time frame PD arrays. So let's actually make this a different color. So let's make this red. So when looking at this portion of price, we see that price is coming from this level down here and is headed for this level right here, right? These relative equal highs up there. Now, if it's coming from here, that means that price has turned around there. And the only place that price can turn around from or change its state of delivery from is PD arrays. All right. And then since this is concerning ourselves with the higher time frame, this would be a higher time frame PD array. So price is coming from this higher time frame PD array, and it's drawing towards this higher time frame PD array. So that's what I mean when I say that price is coming from and going towards higher time frame PD arrays. All right, so that's everything on PD arrays. So now let's move on to the next slide. All right, so for today's example, we're going to be taking a look at the Japanese yen right here and the New Zealand dollar. So the currency pair that we're going to be studying today is going to be NZD JPY. And this is that screenshot from that global interest rate website. And then let me just quickly run you guys through what all of these numbers mean. So right here, these dates are when the interest rates changed, right? So change in interest rates. So we'll abbreviate that as IR. And then this right here is the current rate. And then this right here is that previous interest rate. Actually, Alec made one mistake here. So the current and the previous are switched up. So this right here is the current interest rate. And then this is the previous interest rate. And then as you can see, we had a 4% here, and then it went up to a 4.25. So that means that interest rates went up. So this is the direction that interest rates went. So let's say that this is current, previous, and then this is, which direction that interest rates went in. So in this case, for the Norwegian central bank, they raised interest rates from 4% to 4.25. So you can see that price went up as indicated with this arrow. And it looks like they changed their interest rates on September 21st of 2023. All right, but we're not concerned with Norway. We're concerned with the New Zealand central bank and the Japanese central bank. So as I mentioned with NZD JPY. So right here, we see that New Zealand went from a 5.25 interest rate. Let's make this a different color. That way we don't get stuck with the same color as the other example. So we can see that New Zealand went from a 5.25 interest rate to a 5.50% interest rate, and they raised interest rates to get to there. All right, and then the Japanese central bank went from a 0% interest rate to a negative 10% interest rate. So they lowered interest rates. So let's just concern ourselves with these two numbers right here. All right, so just looking at these two numbers, 5.50 is greater than negative 10. So that means that the New Zealand dollar, or the Kiwi as it's called, should be going up in value against the yen. All right, against the Japanese yen. So that means that this market right here should be predisposed to go higher. All right, and then even before that, we can see that they still had a higher interest rate. So since all the way since 2016 or so, they as in New Zealand has had a higher interest rate than New Zealand. So that means that this currency pair should have been going up for, the past couple of years. All right. So this market is predisposed to go higher, right? Because NZD in the NZD JPY pair comes first. So that means, we're concerning ourselves with the New Zealand dollar. And as I mentioned, it's supposed to go up against the yen. So NZD JPY is supposed to go up. All right, so that's pretty much everything on interest rates. Now let's take a look at the actual charts and then do a top-down approach. All right, so let's go over to my trading view chart. Let me take you guys there. All right, so here is that New Zealand dollar against the Japanese yen currency pair. And then I have that 3 month stuff right here. And then as you guys can see, they changed the interest rates last on Japanese yen in 2016. Price came down for a little bit for Trace, and then now it's going higher as we expected it to. And then, as I mentioned, when starting off on the 3 month chart, we're taking a look at what the institutional order flow is and where price is coming from and where it's most likely to head to. So right here, we can see that price is coming from this level right here. And then it looks like it hit this order block or something like that right there. And then that's what caused price to change its state of delivery from coming down to going up. So we know that right now we're in a bullish market for NZD JPY. And then the next piece of information that we're looking for is the order flow. So let me clear that. So the two conditions of order flow, if you guys remember from the primer video, is, or for bullish order flow, is that up close candles need to support price. So up close support, or sorry, down close support, and then up close get traded through. Up close traded through. And then down close candles are supposed to support price on its way up. So as we can see here, these down close candles aren't, getting traded through. Instead, these up close candles are getting traded through. So right now, it looks like we're retracing back down into this order flow candle right here. And then with everything that I mentioned, with interest rates and all of that, we should, find some measure of support, within here. And then, most likely we're going to maintain that order flow. So that's that bias that I'm building from this quarterly chart. All right, so what's the next area that we should head to? Well, let's think about it in terms of stops to inefficiencies. So right here, we took stops, we came back in for inefficiencies right here with this wick, and then we went higher. And then we didn't necessarily have too many inefficiencies on the 3 month chart here. So, we just went stops, traded a bit lower, retraced, and then we took out stops again, as you guys can see here, took out stops, looks like we're coming back in, and then most likely the next draw on liquidity is going to be there. And it looks like our overall target is going to be this level right here. And this to me kind of looks like a market maker buy model that's happening on NZD JPY. So coupling everything from the 3 month to the, or from interest rates down to the quarterly and all of that, it looks like we're in a bullish market. And this swing high should be our first short-term target. And then it looks like overall, we're trying to draw up into these relative equal highs up there. All right, so that's the 3 month. So let's write that down. Actually, let's clear all this out first. And then let's write down that the 3 month is bullish. All right, so let me turn off my annotations. That way we can go lower. So from the 3 month, what I like to do is I like to go down to a monthly chart. That way I can really refine my understanding of what I'm seeing on the monthly or from the quarterly. All right, so here we can see that order flow is a lot more pronounced. So let me get my rectangle tool. So right here, let's get a different one. Can I get the drawing tool? Looking for the drawing tool. All right, so here it looks like we took out stops, right? We took out stops right there, and then we came back in for inefficiencies. And then now we went higher, took out stops, retraced back inside that range, and then we went higher. And then now it looks like we're coming back down. And then I would imagine that these down close candles, that these down close candles should want to support price as it's trying to go higher, right? So we have one down close candle there. We got a few more down close candles here, right? Because we're on the buy side of the curve. And, from a macroeconomic perspective, there really isn't a reason for us to, really turn around from. Excuse me for not being able to do this, guys. I'm on my tablet, so things are a little bit more difficult. But you can see these down close candles are right here. Maybe we want to dig into a bit more of a discount level in this range, but nonetheless, that logic still applies. These down close candles should still, want to hold up price, and then we have our upside targets still the same as from the quarterly chart. All right, so 3 month is bullish, and then the 1 month or the monthly chart is also bullish. All right, so price is retracing right now. And then once it reaches the level that it's reaching for, it should want to potentially turn over and then go higher as well. So 1 month is short-term bearish, but overall it is bullish. All right, so that's everything for here. Let me get rid of all of this. All right, so from the monthly, we would go over to a weekly chart. All right, so on the weekly, we can see a lot more of those inefficiencies and stuff like that. So let me go back, grab my brush tool. All right, so right here, you can see that inefficiency right here. Oops. Yeah, so that inefficiency that we have right there. And then price is reaching for that level right there. And then it looks like it respected it once, but it didn't want to take out that high. And then looks like it's coming back towards that level again. And then we have a few more days until the end of this month or so. So we should, or actually this week is already closed. So in terms of stops to inefficiencies, we should be drawing towards first this low right here, right? So that low right there. And then if that's not enough, then we should be aiming for this low, because from a stops to inefficiency standpoint, we've already negated the stops, or sorry, we've negated the inefficiency. So now we should, most likely be retracing and going to take out stops. So that's what I'm seeing from the weekly perspective. So let's go back and draw that in. All right, so the weekly is short-term bearish. So why do I say that it's short-term bearish? Whoops. So the reason that I'm saying that it's short-term bearish is because our higher time frames are saying that our higher time frames are saying that our objectives are still above us in price, or they're higher, and we're trying to go higher. But in order to go higher, we need to retrace on the lower time frames and then reach certain levels that we need to rebalance. And that's what's happening on the weekly time frame right now. Price is going back, maybe trying to take out liquidity or rebalance old areas in price before it can deliver to those higher time frame targets. So short term, our bias is going to be bearish from the weekly perspective. All right, so now let's take a look at the daily. All right, and then let me clear out all these drawings. Apologies for the trading view brush tool. It's very hard to do so on the tablet. But basically, let's go to the daily. All right, so on the daily, we can see that we've negated this inefficiency right here. So let's try to use this. All right, so we've negated this inefficiency right here, and then we're reaching for the stops. So this level right here should be a fairly easy target for us to take out for this next upcoming week. And then you can see just how close in proximity that we are to it. And then from there, we would potentially go back to maybe like a weekly time frame or so, and then see if prices hit any significant level. So if taking out this low right here, if taking out this swing low isn't enough for price, then maybe it's going to want to seek lower levels, as I mentioned, from that weekly perspective. All right, so on the daily, this is going to be our first target. And then, after that, we're probably going to go a little bit lower and retrace, just a slightly lower before wanting to turn around based on that higher time frame perspective. All right, so we have short-term bearish on the weekly, and then the daily reflects the same thing. So daily is also short-term bearish. All right, and then now from here, we could stop doing our analysis on the daily, because everything else after the daily is more so intraday. But what I like to do is I like to go down to at least an hourly. That way I can, properly, have certain levels and stuff identified when I go into, my day trading regimen. So that's what we'll do today, and that's what I'll show you guys how to do. So basically, the daily is retracing. So that's why we're short-term bearish. And then we see that being reflected in us negating these stops, or sorry, us negating this inefficiency. And then now we should be wanting to draw to this low and potentially retrace deeper. All right, so that's the daily. Now let's go down to the 4-hour. All right, so on the 4-hour, this is a lot more defined. So we can see that price has negated this 4-hour inefficiency right here. Oops, yeah, so that 4-hour inefficiency got negated. And then now these up close candles are starting to resist price. So let me draw that in. So yeah, these up close candles are starting to resist price. And then price is going down from here. And then price is, respecting these inefficiencies and then coming lower. And then we've negated this bullish inefficiency. So let me bring this tool down here so that way I can show you guys. So we've negated this inefficiency right here. So that means that the next stop for us to go is these stops right here below the swing low at around this 87,100 level. And then that brings us in with that low right there. So that means that the 4-hour is bearish, right? So we have a bearish 4-hour. And then now let's take a look at the 1-hour, and then we'll put all the pieces together. All right, so the 1-hour reflects what we're seeing on the 4-hour. So price is respecting these up close candles. So let's go right here and then draw in this up close candle. So it's not perfect, but as you guys can see, price is respecting that candle right here, these up close candles. So we're definitely on the sell side of the curve. All right, and then that idea is reflected from the weekly on down to the 1-hour. And then, as I mentioned, on the 4-hour, we should be drawing towards this 87,100 level for this upcoming week or upcoming weeks. And then also wanting to take out this low over here as well. So that means that the 1-hour is also bearish. All right, so now let's put all of this information together. So let's move these charts over here, and then let's put this annotation back on. So what we see from here, let's make this a different color. So right here, we see that the quarterly chart is wanting to go higher. But from the monthly chart, we see that price is trying to retrace. Right? So we've already taken out that buy side liquidity on the quarterly chart. So now, price trade stops to inefficiencies. So now price is retracing back inside the range, trying to find a level of support before it can rally higher. But our overall draw is still higher, but we have to keep in mind that in order to go there, we need to first retrace, and then we can start turning around and going towards that level. So this retracement, let's make this a green color. So let me get rid of this and then write it out again. And then you'll see why I'm writing this in a different color. So it's in a retracement. Now this retracement, so this monthly retracement is seen like this on these other lower time frames. All right. Weekly and daily aren't lower time frames, but it's lower than the monthly is what I'm trying to say. So this monthly retracement looks like this. So we see that the weekly is bearish. And then we see that the daily is also bearish. And then we see that the 4-hour is also bearish. And then 4-hour reflects the 1-hour. So that means that the 1-hour is also bearish. But all of this bearishness is just us retracing on a higher time frame. That's it, right? And then I outlined which levels, are potential targets that we should be aiming for as we're going lower. So with all of this in mind, you would be coming into the market with a bearish bias for, potentially the upcoming days or for this upcoming week. So that's pretty much everything on top-down analysis and stuff like that, and how to find a daily bias. So rewatch this video multiple times, especially the part where I go over the actual chart. And then if you guys have any questions, always ask those in the chat, and then I can get back to you and help you with those. But hopefully you guys found this video insightful. And this is a skill that takes, quite a bit of practice to get really proficient at. So really practice this. Go into as many currency pairs and stuff like that as you can. Gain as much practice as you can. And then, as always, just ask your questions in the chat. And then, I'll help you guys there. So yeah, thank you guys for tuning into this video. And then I'll talk to you guys next time. Cheers.